So welcome to this week's episode of Frankly Finance. Lexi and I did not have a topic until about an hour or two ago, and now, as I say every week, we are so excited about this topic. So what we're going to be talking about today is the Great Wealth Transfer. So this is a name that's been thrown around in the media. It's obviously media headlines have called it that, around what's going to be happening in the next 20 years with people inheriting, like inheritances, so the generational wealth transfer between the baby boomers heading on to millennials. So we're going to be getting into this today, which is really exciting. There's lots of figures and we're going to be talking about the impact of it, what people can expect. All of those types of stuff. Yeah.
I didn't really think I had any interest in this topic until you said that this is what we were doing, and I started to really look into it more than I ever have in the past. And now I'm currently like 30 pages deep in a 182-page report from the Australian government about wealth transfers and their economic effects, and I am just like in heaven reading about all of this stuff.
It's so interesting. So it came into my, like, I've always known that it was obviously going to happen, but the actual figures and the amount and the complexity and just the mind-blowing stuff about it, I probably only came into realization in the last year or so, and now I've just been doing some more research for an article and things. So I'm just like, obsessed with that, especially when we're in this economy where we were talking before, you've got 40 and 50-year-olds that don't own a house or they don't have financial stability, and this might be their only avenue. But also, when I've been looking at this as well, and we'll get into it a little bit further, the biggest concerns that I see coming up is this just going to propel the inequity that we have, which is pretty true, right? Like, so the people that need this money are probably not going to be the ones that get it, to be honest.
I did find some statistics around that already to say that based on what has happened already, it's those that are already wealthy that are receiving the largest inheritances, which could be for a number of different reasons. But yeah, we can go into that a little bit more as well.
Yeah. So I think before we get started, I think because the way we're going to approach it, as we always do, is pretty frank, and we probably get a bit carried away and not so sensitive to the people that are watching it. But I think it's really important to acknowledge that obviously being in a position that you're going to receive an inheritance or have an inheritance to pass on to someone is a very privileged position, and we know everyone's not in this position. Potentially we're not, whatever, but we're going to be talking about it pretty casually today, and I hope that doesn't trigger anyone with, we know that this is an amazing privilege to be in a position that will be affected by this great transfer of wealth.
Yeah. And I feel like both you and I have so much to say about this topic. It may be a little bit disjointed.
Okay, all right, so let's get into it. So I'm trying to bring a bit more structure to this. Okay, so what is it? The Great Wealth Transfer it refers to the term that generational wealth is going to be passed on through families. So essentially we're looking at the people that hold this wealth now. It refers to the baby boomers that were born in 1946 to 1964. So these are, 77 to 60-ish at the moment. So it's looking at, in the next 20 years, these people and their wealth that they have, them passing on, and that wealth being filtered down to their beneficiaries, which is generally their family. So it's the transfer of those assets.
They have also been the biggest accumulators of wealth in history. So there's been no other generation that have accumulated as much wealth as these baby boomers. And that's why it's such a big deal.
Huge. It's huge. So they've had challenges and things. These people have been paying off their home loan rates years ago that were 17, 18%. So they've had challenges, but they've also built more wealth faster than any other generation. So baby boomers, this age group at the moment, it makes up for 25% of the Australian population, but they actually hold 53% of Australia's wealth. So they're a quarter of us, but they hold more than half of the wealth. So it's huge, right? Whereas if we look at who potentially is going to be getting this money, it's flowing down to what we consider millennials. So people that currently are to 27-ish, so born between 1981 and 1996. I can't believe people are born in the 90s. It's mind-blowing.
And on millennials, though, there was a study, it was an American study, but it showed that only 11% of millennials have what is regarded as a high level of financial literacy. So I think that's what, like, firstly, it's such a big amount of wealth being transferred, but then it's also being transferred to those who don't necessarily have a very high level of financial literacy. And what are the implications of that? And I think the key takeaway from that is, do they have the skills to be able to then pass on a similar inheritance?
Yeah, so one of my favorite quotes, and I think every time we say a quote, I say it's my favorite, but is, if you can't manage $1,000, you can't manage 100,000. So I think that's really important. But I saw some stats, and I don't have it on me, but it was also that the millennials are less likely to seek financial advice, whereas boomers were more likely to seek out professional services, whereas millennials in general will have more of that attitude. I'll research it myself, I'll do different things, and I can do things myself. So I think that's really important as well, because a lot of this wealth that's coming is they won't have managed that amount of money. But so millennials, if boomers are making up 53% of the population, millennials in this group are making up kind of 15-ish. But they're holding less than 20% of Australians' wealth right now. So it's a huge disparity. But I think it's also important to note, because I don't know if you guys' minds do this, but when I think of my age, right, I'm a millennial, but I am like, oh yeah, I'm born in 1985, so I'm like 25, right? Like, I'm like, you know. But these people, in the next 20 years, when this money transfers to them, they're still going to be like 40 to 60-year-olds. So chances are they've built their wealth, they've worked, they've had good jobs, you know, like, so we're not talking, like, my mind automatically goes to, oh, they're not going to know how to manage money because they're going to be, you know, 20, 25. But these people, some of them are going to be 60 odd.
The average age is 50, like, that's historically the average age has been 50, and that should continue, average age of 50. And then when we talk about intergenerational wealth transfer, that includes inheritances, but it also includes what I would regard as giving while living, which is gifts. So the percentage of those, it's 90% inheritances, and the average age is 50. And then the other 10% of intergenerational wealth transfer is gifts. And the average age, what do you think it is, Gemma?
I would say closer to the 40 mark.
20.
20?
Yeah.
Who's been 20? Wow, that's great.
And in terms of amounts,
first homes, I would say, yeah.
In terms of the amounts, these numbers are a little bit older, like 2018, 2019. So I suspect it would be higher now. But the average, so not the median, but the average amount of a gift was $8,000. The median was $1,000. And then for inheritances, the average was $125,000. But that I know that figure has definitely increased and will continue to increase.
I haven't got any concrete research on it, but I was looking, and the figure thrown around, like in the AFR and stuff, is the average at the moment is about 340,000. I think it was.
I think I saw that figure too. And for those who don't know, AFR is Australian Financial Review.
Oh, yeah, sorry. And it's a pretty credible source, right? It's not like a gossip map. Yeah, so from 2018 being 125,000 average to, you know, if it is over 300,000 now, that's a huge increase already. So that's what the transfer is. What the gravity of it is, why it's mind-blowing, is the amount of wealth, and trying to get your head around this figure, is $3.5 trillion they expect to change hands in the next 20 years, which at the moment, so by 2050, they expect that every single year transferring to one generation to the next will be $224 billion in a 12-month period every single year. That's the amount of inheritance changing hands. It's mind-blowing, like trying to get your head around billions and trillions. Like millions is already hard enough for the average person to imagine how much wealth that is. But what do you think the most common assets are, Lexi? That, because, you know, that's not all cash, right? That's not just here's a check for this. So what do you think the main assets are that are going to actually be inherited or gifted?
Thinking property and super.
Yeah, so cash, like cash in the bank, or like gifting is usually cash that you transfer an amount. So cash, property, and absolutely super. So
Yeah.
when we talk about property for baby boomers, it will generally be their family home. They may have investment properties. A lot of the time people wrap them up in retirement because the tax advantages and the hassle. But mainly I think what will include that figure is the primary residence that they might have, lived in for forever kind of thing.
And if you were like me, you're probably wondering, where do they get these figures from? How do they know that it's going to be $3.45 trillion or 200, whatever you said, billion?
Yeah.
And so I was like, how do they know this? And so it's a combination of a little bit of research into some probate information from some states. So when someone passes away, quite often you need to apply for what is called probate. But there used to be a little bit better, I guess you could say, reporting on this from my understanding before the inheritance tax was abolished in 1979. So Australia used to have inheritance tax. We don't anymore. But there is one being the death benefits tax. So that is, I guess, relevant to this discussion today. And it is applied for that transfer of superannuation. There are ways to minimize this tax. And this is where financial advice can be really, really valuable. And I would say to anyone who has a family member or they themselves have a reasonable amount in super, if you have a terminal illness or getting older, it's probably a really good idea to go and seek professional advice around this.
Yeah. One of my favorite strategies that I used to do as a retirement advisor is when people are getting to retirement age, looking at moving money out of super tax effectively and then moving it straight back in. Because what happens in super right now is imagine in one super fund, there's two buckets. There's a taxable bucket, and a tax-free bucket. The money you put in yourself that's being taxed somewhere else along the way, you might have got an inheritance or sold a property and tax has been worked out some other place, that goes into the tax-free bucket, and money that's come from work that was concessionally put in that you got a tax deduction from, those types of things goes into the bucket that's a taxable component. And you can't pick which bucket you take your money out of. It comes out aligned with portions. But when the big investment, the big super fund gets passed on to an adult child, so somebody who's totally independent, these millennials that are going to be 40 to 60, they're going to pay tax on the taxable component, but not the tax-free. So you can see a financial advisor who can consider both these buckets and look at a strategy as, well, you might want to keep all your money in super, that makes sense. But how do we change these buckets so that if any money goes to a beneficiary, that money is going to stay with your family and your generational wealth rather than going to tax? So it's not about avoiding tax, it's about being really, really smart and making decisions. This is a value that a financial advisor can add. They can look at all of those things for you.
While I was a financial advisor, I did have one particular client she was in her 70s. She didn't have any children herself. She didn't have a partner. She was a single woman. The beneficiary of her estate, including her super, was going to be nieces and nephews. And so, long story short, we did a strategy that saw that tax-free component increase and the taxable component decrease. And if something had happened to her the following day, the tax saving for those beneficiaries, the nieces and nephews, was $70,000. So she would have rather see that $70,000 go to her nieces and nephews rather than to the government. That kind of strategy, it's not like a hard and fast, you will definitely save $70,000 tax, because if she uses all of her wealth in her lifetime, which was very unlikely, and then she passes away at 98, there may be no tax saving. But
it's like an insurance policy, right? You do it because it's not going to affect, it didn't affect her at all. It was a bit of paperwork. No. She probably paid a financial advice fee, maybe these days, maybe $5,000, $8,000. So yes, there was an outlay for her, but it was like an insurance policy. She did it and then she continued on her merry way. It didn't affect her day to day, but it was just that if I do die, then the kids are this much better off.
And that particular client, she was an ongoing client, so she didn't actually pay specifically for that piece of advice. So every firm is run differently, but typically if you have an ongoing financial advisor, you have an ongoing advice fee that is the same no matter what kind of happens during that time. But if something comes up like the identification of some kind of strategy like that, the advice is provided and the implementation of that advice is done, typically for no additional fee. That's not to say that's the case all the time, but for that particular scenario, she didn't actually pay extra. But that's the value of advice, right? The value of having those ongoing conversations every year.
And having an ongoing advisor, because that particular strategy doesn't work when you're working. It doesn't work when you're over a certain age. There's a really, really short window of when that actually works. And the chances of a person, an everyday person, identifying when they can pull the trigger on that strategy and it not being too late, it'd be nearly impossible to do. Yeah. So value advice. Anyway, so that is one way that people can prepare for the transfer of wealth to their family, that they can be looking at tax effective assets and getting financial advice, because there's tax implications of getting property. Pretty much the only tax, am I correct in this, is the only time you're not going to pay tax is if you get cash. Is that right?
Do you mean like if you get a property, you're still going to have capital gains tax and things like that?
Yeah, like there's going to be capital gains tax at some point on a property, but if you inherited 100 grand cash, that's the only time that you're not going to. What other assets are?
Even in the event of property or shares, even if the capital gains tax isn't paid by the beneficiary, if it's converted to cash, it's going to be potentially paid by the initial owner of that asset.
Yeah. So it's just like bank account money and things like that, but there'll be tax triggered. Yeah, when you inherit a property, there's a calculation and like a line drawn in the sand and shares and things. So if you sell them down the track, it'll trigger tax, but cash doesn't do that, like, getting like a check or whatever.
But as we've said before, tax isn't actually necessarily a bad thing. Like you'd rather earn the income or get the gain and pay the tax than not have the gain. Because if money's in the bank, yes, you're getting income, you're getting interest, but you're not getting a capital gain, which is what you're getting with the property or the shares.
Yeah, exactly.
Something that I have noticed with some people that I've been talking to as a financial coach is that the conversations that we are having are kind of, they're nearly, I guess you could say, relying on the receipt of this inheritance. And something that I think needs to be not addressed, but like considered, is that life expectancy is increasing. Every single year, life expectancy is increasing. Although I wonder what happened during COVID, if that impacted, I don't know. But I don't think, even if there is a high chance of someone receiving an inheritance or a gift, it should not be like banked on. You shouldn't rely on it.
Especially if you consider, some of these figures we're looking at, you being 60 before you potentially get it. And as life expectancy increases, that figure is just going to keep moving. You really need to be setting up your finances. And also, so much can go wrong you can be wealthy. So these older people, the baby boomers, they might have a lot of wealth on their side, and then they've made one bad financial decision. They've got sick, a child's got sick, they've had to sell the family home, they've had to move into care. It can go really, really quickly. And I find that when I was retirement planning, people would always project on what their needs were going to be in retirement, and they were generally always spending more than what they projected. So the longevity of that money, but it's definitely not guaranteed. And I kind of feel like the people that I'm talking to, whether they be people my age or clients, is that some people feel like their chances of being wealthy themselves is just so far gone, like them getting into the property market, or, like people just feel so deflated that they're kind of thinking, well, this maybe is my only hope. But as we alluded to before, generally the people that are doing financially well, stereotyping again, privileged position, but people that are doing financially well, generally their parents are the ones that have done financially well as well. Maybe they're not actually the ones that need the money that are going to be receiving it.
And this isn't a pretty big assumption, but I would say that is partly due to the discussions that go on and the experiences that those now adult children have had, that they have seen their parents create wealth. They understand how to create wealth. They have a drive to create wealth. And that is why we're seeing that kind of thing happen.
And they've had opportunities that potentially other people haven't.
Yeah.
You know, maybe they've gone to university and they've got their uni fees paid. Maybe they've had other opportunities. And there's a really good saying that I can never remember, but it's something along the lines of I need to, because I say it all the time and I have this big spiel about it, I can't remember it. But it's something about you can't compare outcomes without comparing the resources. Like their childhood and stuff, you can't compare. Like you can't go, so I'm 40, I'm a single mum, they're 40, a single mum, why don't we have the same lifestyle? Because it's totally different to how we grew up and what opportunities we've been given. So you can't compare. Yeah, exactly. And that can change like that, right? You go through divorce like I just did, and you split, not halved, but split. So health changes, you know, you can no longer do the job that you used to because of mental health issues or disability. Like things just change so quickly.
Yeah. Also, that is, of course, not always the case, that those who have wealth then receive more wealth. There is a lot of times whereby, as we alluded to earlier, that wealth is going to people who aren't financially literate. And what can be done now or in the future to help that situation? So I sometimes have conversations previously as an advisor, now as a financial coach, with people in typically their 30s, who their parents are paying for financial coaching or financial advice so that they can get their adult children up to speed and increase their financial literacy. So when that transfer does happen, they can feel really confident that it won't be wasted and that there is a higher chance or likelihood of a portion of that wealth then being transferred on to the next generation and then the next generation, and the impact that can have on everyone's lives. So it's not about like not spending money. It's about the fact that these parents, like the baby boomers, they care about their children and their grandchildren and their great grandchildren, and they want to see them and facilitate that life that they want them to have. And money touches every aspect of our lives. So if they can give the money, then they can touch every aspect of that person's life.
And that's a legacy, right, that they're passing on to great-grandchildren that they potentially haven't met. I think that's key. So I think, like we said earlier, if you can't manage $1,000, you can't manage 100,000. So regardless if you're counting on an inheritance, it's going to be a surprise, or you've just got to really get your shit together because there's nothing there. Your financial foundations and getting your money stuff sorted and taking ownership of, like, maybe you want to break the generational issues that your family has created, the money problems, like, and you want to go, right, I'm not going to get an inheritance, but I want to make sure that my kids do. Or there's a charity that I'm really passionate about and I don't have kids, but I would love to pass on a legacy to them. So it's not always about, okay, I'm going to get an inheritance. What do I do with it? Make smart choices. Maybe it's that one of your financial goals is to actually break a cycle and change for how you're passing on wealth. But there's key steps to doing that. So your foundations, your financial stuff, like your basics, managing your cash flow, managing debt if you've got debt, getting rid of debt, having your basic living expenses met, and all of that kind of foundational stuff. Money coaching can help with that, and then getting financial advice and knowing the position, the timing around it. And so maybe that's, you check in with an advisor every few years and they help map out, saying, one of the strategies we talked about before, there's a fine window. Maybe they help you map that out. They have to come back to them. But there's so many different resources that you can do to make sure that you're in the best position to provide an inheritance, receive an inheritance, or just look after yourself, right? But these figures are just absolutely mind-blowing. And I think even if it doesn't impact you, it can get your brain, you thinking motivated about your own situation and go, well, that's not going to be part of my journey, but I need to look at this, or I want that to be part of my journey. The other way.
And this discussion on intergenerational wealth transfer also ties into estate planning and the advice that you can receive advice from a financial advisor. You can also receive advice from a estate planning solicitor, whereby they may talk to you about the appropriateness of things called testamentary trusts. So they can also be a really good tool with intergenerational wealth transfer and the protection of money as well for a bloodline.
Yeah. If you're going to go to the trouble of getting a financial advisor and setting yourself up in the best position, then you also need an estate planning lawyer who's going to protect that, protect it from a divorce, whether it's yours, protect it from, your kids getting money and then them potentially getting divorced, and it's not staying with your bloodline. So that's where a testamentary trust comes in.
Yeah.
If you're going to go to the effort of building wealth that can be transferred, getting advice on being tax effective, you absolutely want to protect it as well. It's like the group, right? You need to make sure that you've got all of these things, and it's not hard. You can get professionals that help you with this. But the worst thing would be to work really, really hard to build up this wealth and then have it transferred, not tax effectively, to someone who's not prepared and able to manage it. Yeah, and it just be lost. There's such a great opportunity, and privilege that comes with that.
Yeah.
But on that quickly, I've also met people, given financial advice to people that have come in and been like, I've just inherited this money, whether they were 20 or 60, and they just feel so much guilt. They can't make decisions on what they want to do with it. They don't want to risk it. They don't want to spend it. They feel like it's not theirs. There's a whole psychological element that comes to this that we haven't even touched on.
I had a meeting for that exact reason not too long ago. It was a one-off meeting, and it was someone who received a gift giving while living, and it was a couple of $100,000, and they didn't want to do the wrong thing with it. And so our meeting was to talk about their options, and they thought they had a couple of options. When we nutted it out, they had 13 different options for this money. And then we looked at the pros and cons of absolutely every single one. And then they were able to make a more informed decision on that. It wasn't me telling them what to do with their money. It was helping them map it out and look at their different options and be that sounding board so that they could really confidently do something with that money.
Yeah. Yeah. I can imagine it would feel like a huge responsibility to do great things with it if you're in that privileged position to get money. But yeah, the key takeout is advice, regardless if you're the one that potentially is going to be transferring the wealth, dying in the next 20 years. Sorry to be blunt. It's one of those conversations with a financial advisor. You're just like, well, we have to be frank, you're going to die at some point. So you need a will.
Yeah.
But yeah, so regardless if you're the one, you need advice because you're transferring or you'll potentially need to get your ducks in a row because that might be something that is part of your plan. You know that it's coming in. Yeah, it's advice is always, very rarely not the answer, I think.
Well, I will not see you next week because I will be cruising the Pacific Ocean. And I won't see you the Friday after that because I'll be coming back, but then I will see you the Friday after.
Yeah, so the next 2 weeks. So next week I have one of my best friends that I've worked with for many, many years. Emma Stevens is a mortgage broker. So she's coming on next week and she'll probably be at my house. And then the week after we have one of the founders of Finito, who's also an amazing advisor. Him and I are going to chat about retirement strategies and geek out on the strategy probably that we alluded to today and heaps of other exciting ones. So I will see you the next 2 weeks and we'll see you in 3 weeks.
Okay, bye.